Let's now do illustration number 6 of the comprehensive illustration section. Now, illustration number 6 actually requires you to apply the concept of effective interest rate. Now, effective interest rate is a topic that is covered under the recognition of financial assets and financial liabilities at amortized cost. And over here, we are going to apply that topic. So, you will absolutely understand illustration 6 if you know the effective interest rate topic already. But even if you do not know, all you actually need to do is apply that effective interest rate in this question. The effective interest rate actually is straight away given away in the question as 15.86. You only need to apply it. How that effective interest rate is calculated and all that, you will actually learn in a separate topic. So even if, let's say, you do not know about effective interest rate, my suggestion would be to go ahead with with this illustration or with this question and only know how to apply it, how to calculate that effective interest rate and why we calculate it. You will understand in much more detail when you actually cover the topic of amortized cost measurement. All right. So let's actually start with illustration number 6. ABC company has issued 10,000 compulsorily cumulative convertible preference shares. All right, it's probably supposed to be cumulative compulsorily convertible because it's compulsorily convertible and cumulative in nature as on 1st of April 2021 at rupees 150 each. The rate of dividend is 10% payable every year. The preference shares are convertible into 5,000 equity shares of the company at the end of fifth year from the date of allotment. All right. So on 1st April 2021, it issued on 31st of March 2026. These will be compulsorily converted. You don't have an option. Neither does the holder have an option, nor does the issuer have an option to actually choose to convert. They're going to be mandatorily converted at the end of fifth year. When the preference shares are issued, the prevailing market interest rate for similar debt without conversion option is 15% per annum. Transaction costs on the date of issuance is 2% of the value of proceeds. All right, so they're saying that the transaction cost is 2%. Obviously, to issue shares, to issue preference shares, you would incur certain costs, right? Like legal costs, the process of making a prospectus, distributing it, and so on. The costs are 2% of the value of proceeds. Key terms: date of allotment, it was given on as 1st of April 2021. Date of conversion is 5 years later, so 1st of April 2026. Number was also given in the question of 10,000. The issue price was equal to 150. So the face value and issue price are equal. All right. So there's no share premium that was collected. Face value and the issue price are equal to 150. So the proceeds are going to be 10,000 multiplied by 150, which is equal to 15 lakhs. The rate of dividend is 10%. Remember, these are cumulative, which means that if you skip paying dividend in 2022, all right, the first dividend will ideally be paid on 31st of March 22. If you skip making the payment on 31st of March 22, you have to pay 2022 and 2023 dividend in the next year. In the next year, you will have to pay dividend for the previous year and for the running current year. All right, and therefore, because they're mentioned as cumulative. All right, because it is cumulative dividend, the dividend actually has the nature or characteristic of liability. Remember, the dividend actually has the nature or characteristic of liability because they are cumulative in nature. Market rate for similar instrument is 15%. Transaction cost is given as 30,000. All right, it's 2% of the issue proceeds. The issue proceeds were 15 lakhs. 15 lakhs multiplied by 2% is equal to 30,000. This is the first question where we are actually seeing a transaction cost. Until now, we actually did not see any question having a transaction cost. The face value of equity share of conversion, which is going to be issued on conversion, is 10 rupees. All right, the shares that we are going to issue, their face value is going to be equal to 10 rupees. The number of equity shares that was also given in the question, the number of equity shares is 5,000. And they've given us something called as effective interest rate, which is 15.86 percentage. This effective interest rate is going to be used for recognizing interest on the financial liability. All right, we are going to use this 15.86 percentage to recognize interest on the financial liability. You would have learned this as part of recognition of financial liabilities under amortized cost approach. All right, the discount rate that we will be using for discounting the future cash flows will actually be 15% only. All right, for discounting the future coupon payment or the future dividend payment into today's terms, I will be using recognizing the market rate as 15 percentage, but the recognition of interest will not happen at 15 percentage because we actually incurred transaction cost. All right, because we incurred transaction cost, the rate at which we recognize interest is going to be greater than 15 percentage, and the interest over here will be 15.86 percentage. All right, so we will be recognizing interest expense at 15.86 percentage. You are required to compute the value of liability and equity and pass journal entries for the entire term of arrangement, from the issue of preference shares until their conversion into equity, keeping in view the provisions of relevant Ind AS. All right, so let us actually start. The first step would be calculation of liability. The liability, because the dividends are cumulative in nature, the dividends have the characteristic of liability, and we will calculate the liability amount as the present value of the future dividends, present value of the dividends to be paid for the next 5 years. Why am I saying 5 years? Because the term of the preference shares was actually 5 years. All right, so we will actually start off. We have years. We will have an annuity cash flow for years 1 to 5. The cash flow amount is going to be 15 lakhs, which is the face value, multiplied by the dividend rate was equal to 10 percentage. If I'm not wrong, the rate of dividend was equal to 10 percentage. So 15 lakhs multiplied by 10 percentage is equal to 1 lakh 50,000. We then have present value factor, and we will calculate the present value factor at 15 percentage. The reason we are going to calculate it at 15 percentage is because this is the market rate for similar instruments. All right, we are going to use the discount rate as the market rate for similar instruments, and this will be an annuity factor calculated at the rate of 15 percentage for the next 5 years. This answer is going to be equal to 3.3522. All right, it's going to be 3.3522. The discounted cash flow will then be equal to 1,50,000 multiplied by 3.3522, which is going to be equal to 5,02,830. All right, so the discounted cash flow will be 5,02,830, and this will be the value of liability. Therefore, the value of equity is going to be, the value of equity will be equal to total proceeds, which is 15 lakhs minus 5 lakh 2,830, which is going to be equal to 9,97,170. All right, so the value of liability will be 5,02,830. The value of equity will be 9,97,130. All right, this instrument is classified as a compound financial instrument, and therefore we bifurcated the value between liability and equity. Why was it a compound financial instrument? Because with respect to dividend, there was an obligation to pay cash, and hence it had the characteristic of liability, whereas with respect to the principal amount, there was no obligation to pay cash. There was an obligation to issue a fixed number of equity shares, which is the characteristic of equity instrument, and hence we classified this as a compound financial instrument, and we calculated the value of liability and that of equity. Therefore, I'm just summarizing. So liability is equal to 5,02,830, and equity is going to be equal to 9,97,170. Now over here, to issue this compound financial instrument, we actually incurred a transaction cost of 30,000. We incurred a transaction cost of 30,000. Before we see the how the transaction cost is dealt with, let's actually plot the journal entry for this. The journal will be bank account debit of 15 lakhs to financial liability 5,02,830, and to equity will be 9,97,170. All right, so this is going to be the journal. Now the next part is we actually incurred transaction cost of 30,000. Now, how are the transactions costs going to be dealt with? Now, if you think of it, the transaction cost has been incurred for the purpose of issuing this compound instrument. Therefore, the transaction cost is attributable both to liability and equity component. The transaction cost is attributable to both the liability and the equity component. What we are going to do is we are going to actually calculate the amount of transaction cost which is attributable to the liability and the amount of transaction cost which is attributable to equity. All right, so the transaction cost attributable to liability will be calculated as 30,000 multiplied by 5,02,830. 30,000 multiplied by 5,02,830 divided by 15 lakhs. If you think of it, the amount of liability was 5,02,830 out of the total proceeds of 15 lakhs. So what we are doing is we are calculating what is the proportion that is attributable to liability component by taking the proportion of liability multiplied by 30,000, which is the amount of transaction cost. All right, so it's going to be equal to 10,056 or 57. All right, so it's going to be 10,057. 30,000 multiplied by 502,830 divided by 15 lakhs is going to be 10,057. Next, we have transaction cost, which is attributable to equity. The transaction cost attributable to equity is going to be equal to the same way we will have 30,000 multiplied by the equity value, which is 997,170, 997,170, the whole divided by 15 lakhs. All right, so the second part of this formula, the second part represents the proportion of equity out of the total sale proceeds, and we are actually multiplying that with 30,000 to actually arrive at the transaction cost attributable to equity, which is going to be 19,943. All right, so the amount attributable to liability is 10,057. The amount attributable to equity is 19,943. Obviously, if you take the sum total of 10,057 and 19,943, it should be equal to 30,000. The 30,000 is being split into liability and equity, and therefore the sum of 10,000 plus 19,000 will be equal to 30,000 itself. Now, the journal entry for this is going to be the journal entry for transaction costs will be you will debit the financial liability component. All right, you will debit the financial liability component by 10,057. Earlier, you credited the financial liability component by 5,02,830. You credited the financial liability component. Let me write it as component and component because this is the financial liability component of the total proceeds. The second one is equity component of the total proceeds. So now I'm going to debit the financial liability component by 10,057. I will debit the equity component by 19,943, and I will have credit bank of 30,000. Obviously, these transaction costs are going to be paid in the form of cash. Therefore, I'm crediting bank. All right. So we are actually going to attribute the transaction costs into the liability component and the equity component, and we will actually recognize them and recognize an outflow of 30,000. All right. We're going to pay cash of 30,000, and therefore we recognize the financial liability component, and the corresponding debit goes to the financial liability component and the equity component. After this, after the incurring of transaction costs, the net financial liability component recognized in the books, the net financial liability component recognized in books is going to be equal to, we had 5,02,830, we had 5,02,830 that was initially recognized. From that, I'm de-recognizing 10,057. Why am I saying de-recognizing? Because I debited. All right, it's not really a de-recognition, but because I debited 10,057, my liability reduces by 10,057, and therefore the net liability in my books will be 4,92,773. The net equity component would actually be equal to 9,97,170. If I'm not wrong, it was 9,97,170 less. I have the transaction cost of 19,943. The equity value also reduces by the amount of transaction cost, and the amount that will be there in the books of accounts after this will be 9,77,227. All right, the amount that of equity recognized in the books will be 9,77,227. I'm not taking the sum total, but if you take the sum total of these two, it would ideally be equal to 14 lakh 70,000. How is it 14 lakh 70,000? The total proceeds were 15 lakhs. Out of that, I paid out 30,000 as transaction cost. Therefore, I have 14 lakh 70,000, which is getting bifurcated into financial liability and equity component. All right. So first we take the total proceeds of 15 lakhs and calculate the financial liability component and equity component, and then we attribute the transaction cost to both the liability component and equity component, and the net financial liability and net equity component is arrived. This is as of day one. This is all these journal entries are as on the 1st of April 2021, which is at the time of issuing the preference shares. All these journal entries are at the time of issuing the preference shares. Now, if we start preparing the liability schedule, all right, let us actually prepare the liability schedule. We will have years, we will have beginning balance of liability. We are then going to recognize interest not at 15 percentage. In the previous examples, we were recognizing interest at the market rate of interest, but over here, we are going to recognize interest using the effective interest rate given in the question, which is 15.86. Why do we have a effective interest rate of greater than 15 percentage? The answer is because we actually had transaction costs. If there were no transaction costs, then interest would also be recognized at the market rate of instrument. Because we have incurred transaction cost, we are recognizing interest at a higher rate. All right, we are recognizing interest at a higher rate. If you have not done the chapter where we learn financial liability recognition using amortized cost approach, don't worry, you will actually learn it as part of that. How do we calculate effective interest, and all of that is going to be learned as part of that chapter. For now, you can actually think that we are going to recognize interest at effective interest rate. We then reduce cash flows. We then have cash flows which reduce the liability, and then we have the closing balance of liability. Now coming to year one. At year one, what was the beginning balance of the liability? What was the beginning balance of the liability on 1st of April 2021? The answer is not going to be 5,02,830. The answer is not going to be 5,02,830 because on day one itself, after recognizing 5,02,830, you debited or reduced your liability by 10,000. Therefore, the liability at the beginning of year one was actually 4,92,773. It's 4,92,773. You then have interest, which is recognized at 15.86 percentage. It's 492,773 multiplied by 15.86 percentage. Interest is going to be 78,154. At the end of year one, we are going to actually make a payment of dividend of 1,50,000. Remember, it is 15 lakhs multiplied by 10 percentage. The cash outflow is going to be 15 lakhs each year multiplied by 10 percentage, which is 1,50,000. All right, the cash outflow each year will be 1,50,000, and therefore the closing balance of the liability will be 492,773 plus 78,154 less 1,50,000, which is equal to 4,20,927. Now moving on to year two, the beginning balance of year two will become 4,20,927. Whatever is the ending balance of year one will become the beginning balance of year two. Multiplied that by 15.86 percentage. The interest for the second year will be based on this beginning balance. All right, 4,20,000 is the net liability that was outstanding throughout year two, and therefore I recognize 15.86 percentage on this 4,20,000, which is going to be equal to 66,759. I again have a cash flow of 1,50,000 for year two as well, and my net liability will be 4,20,927 plus 66,759 less 1,50,000, which is equal to 3,36,686. My beginning balance for year 3 will be 3,37,686 multiplied by 15.86 percentage, which is going to be 53,557 less 1,50,000, which is going to be equal, my closing liability will then be equal to 337,686 plus 53,557 less 1,50,000, which is equal to 2,41,243. All right, so my closing liability will be 2,41,243. That will become my beginning balance for year 4. 2,41,243 multiplied by 15.86 percentage will be the interest for year 2, which will be 38,261 less 1,50,000 of payment, and my net liability will be 241,243 plus 38,261 less 1,50,000, which is equal to 1,29,504. For year 5, my beginning balance will be 1,29,504 multiplied by 15.86 15.86 percentage, which will be the interest for year two, which is 20,539 less 1,50,000. I'm going to make the payment for year five also of 1,50,000. The net liability will then be equal to 129,504 plus 20,539 less 1,50,000, which is equal to 43. Ideally, this 43 also should not have existed. My liability in the book should have gone down to zero at the end of last year. But because this is outstanding, what I will do is I will actually round off the interest for the last year. Instead of recognizing 20,539, I will recognize 20,539 less 43. All right, I'm actually recognizing an interest only of 2496 in such a way that my closing balance actually becomes equal to zero. All right, if I recognize an interest of 20,496, my closing balance will exactly be equal to zero. 129,504 plus 2496 less 1,50,000 is going to be exactly equal to zero. So for the last year, I will recognize an interest of 20,496. Now I actually have a question. In illustration 2 that we did earlier, under the comprehensive illustrations, the comprehensive illustration 2 that we did earlier, at the end of year 8, we were actually left with a balance of 1 crore rupees. All right, we were left with a balance of 1 crore rupees in the liability account. We were left with a balance of 1 crore rupees in the liability account, whereas in this question, we are left with a balance of zero. The question is why? The difference lies in the fact that in this question, these were compulsorily convertible, and therefore, at the end of fifth year, you are definitely not going to have an obligation to pay cash, and hence the liability actually went down to zero. Whereas in illustration 2 that we did, over there, the holder had a right to either choose to convert or redeem it in the form of cash. They had an option to either choosing to convert or redeeming it in the form of cash, and therefore we still had a balance in the liability, because if the holder exercised its right to receive cash, if the holder wanted to receive cash, then we still were obligated to pay cash, and therefore there was a balance left in the financial liability account. Whereas over here, at the end of the fifth year, we are actually having zero balance because we are not going to have an obligation to pay the principal amount in the form of cash. All right, so that is how we are actually going. That is the reason why we are actually having a value of zero over here, whereas in illustration 2, we were left with some liability balance. All right. The journal entries for this is going to be, for the interest, the journal will be interest expense debit to financial liability component. All right. We are adding the amount of interest to the amount of liability. We recognize 78,000 as a debit in the P&L as interest expense debit, and we increase the financial liability. Interest expense debit by 78,000, whatever that number was, 78,154, and we credit financial liability component. All right, we're crediting the financial liability component by the same amount of value, 78,154. When the payment is being done, we debit the financial liability component. We debit the financial liability component by 1,50,000 and credit cash by 1,50,000. Therefore, we actually had a beginning balance of liability of 4,92,000. Since we are crediting the liability by 78 and debiting the liability by 1,50,000, the liability is actually reducing each year. From 4,92,000, it came down to 4,20,000. From 4,20,000, it came down to 337, and that way it was going down to actually zero. It went down to zero at the end of fifth year because the company is no longer having any obligation to pay cash. The company is having no longer is having no obligation to pay cash, because these are going to be compulsorily converted into equity shares. They're going to be compulsorily converted into equity shares. So these journal entries will actually be passed for the next 5 years. For the next 5 years, the journal entries will be exactly passed, and there will be no change. The only change will be obviously the amount of interest expense, but the journal entries are going to remain the same for the next 5 years. Now, at the end of fifth year, the preference shares are going to get converted into equity shares. The preference shares are going to get converted into equity shares. So at that point, when the preference shares are going to get converted into equity shares, the journal entry will be, we will debit the equity component. All right, we are now going to debit the equity component, the amount of equity component that is left, the amount of balance left in the equity component ledger is 977 227. Initially I recognized the equity component as 997. From there I reduced the transaction cost, so the net credit balance left in the ledger of equity component is 977 227. So I debit 977 227, and since equity shares are being issued right now, I will credit equity share capital and share premium. If I'm not wrong, the number of equity shares that we are issuing are actually equal to 20,000, is it? Sorry, we are issuing 5,000 equity shares, and the face value of equity shares is 10 rupees. We are issuing 5,000 equity shares and the face value is only 10 rupees. So this will be 50,000. 5,000 multiplied by 10 rupees, which is equal to 50,000, and the balancing amount will go to share premium. The balancing figure will actually go to share premium, which is going to be equal to 9,27,227. All right, so what will go into the share premium will be the balancing figure of the equity component being de-recognized. Equity component earlier had a credit balance of 977. I now debit equity component by 977 and I credit equity share capital of 50,000 and share premium of 9,27,227. All right, so with this, we are actually done with illustration number 6 of the comprehensive illustrations section. Let's actually maybe quickly also take a look at the institute solution. We had a liability of 492,767. All right, we were recognizing interest each year. The interest for the first year, let's match it. Was it 78,000? I had 78,154. They have 78,153. And the liability is going down to zero at the end of last year. At the end of fifth year, it's going down to zero. So in year one, I am actually they have actually done the net entry. They have done the entry for 14 lakh 70,000. What I have done is I showed the entry for 15 lakhs receipt and also the entry for transaction costs. But the amount that we have, obviously, they also calculated it in the same way. 492 and 977, they also would have calculated it in the same way. All right, I had 977 227 if I'm not wrong. They have 977 233, which is purely because of rounding. Every year what we are going to do is we are going to recognize finance cost or interest expense. 78,153 is the finance cost credit liability, and what we are going to do is we are going to debit liability and credit bank for the payment of dividend. That is going to be the journal entry every year. This is 31st March 22, 31st March 23. We then have 31st March 24, 31st of March 25, and 31st of March 26. On the 31st of March 26, these are going to get converted mandatorily into equity shares. Therefore, you debit the equity component, credit share capital by the face value, and credit share premium by the remaining amount. All right, so that is how we are going to solve the answer. All right. The nomenclature I have been using as financial liability component and equity component. You can obviously use the nomenclature that the institute has used. Preference shares liability and equity component of preference shares is the nomenclature that the institute is actually using. Just one point that I would like to clarify is that the equity component is also going to be a part of the shareholders funds itself. Remember, the equity component of preference shares is going to be disclosed in the shareholders funds itself. When the equity shares are issued, there is going to be no change to the shareholders funds as a total. Shareholders funds as a total is not going to change. What is only going to change is the components within the shareholders funds. Earlier there was a row called equity component of preference shares. Now instead of that, we are actually going to disclose it in share capital and share premium. All right, earlier it was being disclosed in a separate row called as, say, equity component of the preference shares, but now within the shareholders funds we are actually reclassifying it to equity share capital and share premium. All right, so actually issuing equity shares over here is not going to result in change in shareholders funds in totality. It's only going to move from one row to another row. With that, we are done with illustration number 6 of the comprehensive illustrations as well.